this is the thing with like you professionals, right? We had also Sandgram, obviously kind of similar caliber like you, I think, especially in this one here. And, when I listened to the episode, I was like, wow, Tony, that was a shitty question. But the thing is, because you guys, I've done this so many times, you just knock the answer out of the park anyway, right? It's not the quality of the reporter anymore. It's the anyway.
The thing is, the host talent, it doesn't really matter when the guest is so great, like the one we have today. And that's actually pretty amazing. So we have once and again Jacco van der Kooij with us. Welcome, Jacco.
Oh, wow.
Pleasure. You're just on the phone here. Pleasure to have you. A lot sooner than I kind of thought, but very, very pleased to have you here with us. If you, the listener, don't know Jacco,
which probably isn't the case.
I hope it's not the case. If not, winningbydesign.com, go and read about the bow tie or watch some of his famous videos. There's occasional music in there.
And the music is
just really lightens the whole feel of it. He is known to provide deep and well-articulated SaaS insights, also well-researched, and of course also known for being a previous guest on this show.
And he's very well known across the whole industry for taking off his shirt on our show the last time.
That's true. So, and I was just gonna say, like, we talked about buttering people up. We're buttering up the guests here.
Yeah, that's true.
That's what's happening.
Yes.
That's what's happening. But so I wanted to just start off with a slow ball and say, welcome. What have you been up to the last it must be 4 to 6 months since we last spoke?
Yeah, like a lot of it has been talking about revenue architecture. And I think a lot of it has been dealing with the things that are going on in the industry, trying to talk people off the ledge and stuff like that. Because many people either have lost, not many, but there's a group of people who've lost faith in SaaS, misinterpreted and stuff like that. So that's where I've been busy with.
And I think in between you published also a book. It came out, January 2nd?
Yeah, I have no idea what the official publication date is. But yeah, that book, Revenue Architecture, was a large piece of my work that I've been working on over the past 5, 6, 7 years. That finally got the time to put it together. And the book, Revenue Architecture, primarily is about a more modern approach to setting up a rapid growth company, which most cases are either a subscription or usage-based company, but taking away the veil and describing where does it come from, how does it actually work. I think one of the things I found over the past few years, particularly when the market turned south on SaaS, how few people actually know how to operate it. And the best way for me to describe it sometimes is like people are sitting in a rocket, but are driving it like a car and are touching the handles and are touching the pedals. They go like, that's how a car drives. Let me see how this, and like, they're steering that rocket ship of growth, sometimes up accidentally and sometimes down accidentally. They just often don't know, due to lack of education, how to operate it. That's what revenue architecture is about.
That's why we're here. And, you obviously is kind of to come up and spread the word on the methodology, and we're helping to amplify that as much as we can.
Yeah, that's right. Now, I think that what we're going to see, and I think that also applies, and the reason why, I like to consider myself a return guest on your show, is tooling plays a very important role in here. I think that we often misunderstand that. We often think that the way a SaaS company starts, which is based on superstar performance, whether that is a founder or a group of founders, but once it takes off, you're relying on systems and processes, which in execution ends up being tooling. And that can be a wide range of tooling, but obviously your folks at Growth Blocks know everything about this as you provide one of the fundamental tools for this.
That's it.
So last time, Jacco, we spoke about a ton of metrics that were basically going sideways. You had just launched the Solving Underperformance Research. Since then, you launched one that was cheekishly titled, Has SaaS Lost Go-to-Market Fit? And what I'm really curious, is what are you actually seeing today? What is it the SaaS businesses and those GTM teams, they need to know is happening right now?
Yeah, I think that in many cases, SaaS did lose go-to-market fit, and it's primarily on the basis that the pricing no longer is sustainable. Mm-hmm. For me, pricing is a go-to-market fit element. And if your pricing, not if it's off by 5 or 10% and you're competing against it, but if you're off by 20, 30, 40%, then essentially you got a go-to-market fit issue. That will be felt in product, in all the way back into product market fit, where you are going to find that pricing needs to be reestablished, and that may change the profit margins of the product and whatnot. And so you may have to go back all the way to product market fit. That pricing combined with the increased cost of sales and, has led to a loss of go-to-market fit. So pricing pressure up 5 to 10%, that's fine. That's, you can compete with that. But if the pricing starts to drop 20, 30%. And what I wrote about in that paper, Mikael, was that NRR would be next, right? And this paper was written like 6 months ago. And guess where we are today? NRR is next. Now, good news, NRR will be the final part of the storm. But yeah, we are in that, we started to open up with that NRR metrics for the next 3 to 6 months.
But the reason why you're saying go-to-market fit is lost, because of ACV pressure, is ultimately because the CAC payback, right, where all of this comes together per a specific motion, suddenly is so out of whack that you basically say like, well, it's too far off. You can't scale this. You can't do this sustainably, and therefore go-to-market fit is lost, right? I just want to kind of frame it in that direction.
Yeah, you're absolutely right. Note, Tony, that it is not just CAC payback. It is also what follows next, the payback of that, and whether that is cost to serve payback, whatever we refer to that. But the cost of retention and expansion is significant too. And it's significant because it takes place over a number of years. And so the combination of that, right, a large upfront cost with a growing cost to retain and expand the customer combined, right, those two combined, that offers the long-term sustainability and valuation of companies. That's where they have taken a hit on that, right? And every now and then you see the publication of like, exceeded certain growth targets, but stock went down. Why? Yeah, your cost of maintenance and cost of expansion is way, way, way too high.
So I'm wondering if you want to set the stage for the listener and what we're going to talk about today, because you're such a great narrator. I think I can't do the topic justice. I would love for you to maybe set the stage for us here so we can dive into the subject.
Sure. Yeah. Like what I find is that we're in a great moment of change. A radical moment of change that we all find ourselves in. What I notice is when you're in that moment of change, you often experience it, but not to the extent of that the gargantuous nature of that change. This is one of those moments that we're in. It's like the first week of COVID, we had no idea that within like a few weeks later, all the airports would literally stop flying. You could not get a flight any longer. And I always look back on that moment that I drove on a highway during traffic jam hour, and I go like, there's no car. I'm calling my wife like, there's no cars on the road. Today we are in that first week of COVID. We do not understand yet what is changing and how big that change is, and as a result, we are not taking the right actions right now. Organizations are holding back, and that's fine. It's not. I just want to make sure that we have on record that there was once a time when the three of us got together in a room that we predicted what was about to happen, and that we go like, okay, here's where we're going. And what I also find is that the future is not that unpredictable. We can predict what is going to happen, and we can prepare for that. But we got to take action, and we can't sit still. And so that's, I think, a great topic for us to talk about today is like, where do we go with that?
So, but let's take this analogy one step further. So what's the oh shit moment? I'm on the highway in LA, traffic jam hour, and there's no one around. How does that come to be in SaaS right now? Kind of, what are the signs that you're seeing where you say like, hey, this is what's going on? And maybe you're only one of the few ones that's actually seeing it. Yeah,
it comes down to this: SaaS as a business, a subscription and usage-based business model. And for all intents and purposes, I will use usage as a form of subscription as it is recognized. Okay,
Yeah.
So subscription, it covers both. That is the best business model. It grows the fastest, and it will suit us for a decade or more to come. For the next decade, it will be the best business model. The problem is the oh shit moment, as you so refer to it is being not operated as such. Day in, day out, it is being used and operated primarily by VPs of sales and CROs who operate it as a rapid growth acquisition strategy. And that is not the case. What I'm predicting is that SaaS within like a few years will be under the realm of the CFO more so than under the realm of the CRO, because the CFO understands where this comes from. The reason why I'm saying that and why it is, like, I continue to see CROs who often control SaaS make the adverse impact on the business. And just over the past 3 weeks, I have spoken to CFOs at companies, several of them at $100+ million in revenue, and they keep making that mistake. And I will elaborate a little bit in a second what it is, but in detail. But what it is about is like, you cannot shift during this moment of downturn your sales resources to start upselling and cross-selling customers, because the cost of that is way, way, way too high. And so this rocket that they're flying and the adverse behavior that they're having is deploying their sales resources at an extreme high cost to start harvesting customers' revenue. Very dangerous. And not customers as a new customers, right? As an existing customer's revenue. And so that is a very dangerous precipice that we're on, that we see many companies make a mistake on.
And when you say kind of CRO versus CFO, for me, besides the letters and the background, it's almost kind of a long-term versus a short-term kind of perspective, that those two profiles, how you can differentiate them sometimes, right? CRO is like, I need to hit my quarterly target, and that's in front of me right now. CFO thinks about, no, we not only need to hit the year, we need to hit the next several years. And having kind of a different perspective, is that how you're kind of seeing it? Or is it really hey, these CROs, they don't get it, and the CFOs do? What's kind of, how do you see that?
Let's give a simple example. I'm selling $1 million piece of software, perpetual. I've sent it to you on discs, right? Like, let me go back. Okay, I sent you $1 million on disc. I close the deal. When does the deal get recognized?
Immediately.
When do I get paid?
I don't know, 30 days later.
30 days later, let's say 90%, and we'll hold something back. How much profit do I make 60 days later?
A lot.
A lot.
Profit.
Okay. And I can already subtract my cost of sales and everything from it. Now let's apply that to SaaS sales, a subscription revenue. That takes place over years. Over those years, my costs increase, and some costs amortize and some costs don't amortize, right? Like my things compound. The whole machine is way more complicated. Do you ever see a VP of sales or a CRO acting with that mindset when they close a deal? They don't.
Yeah.
And whether they gave too much discount away, whether they construct a deal in the wrong way, whatever it is, the CRO doesn't think about this. Now, imagine during the 2012-2021 timeframe, when there's so much revenue laying around, wherever you go is just grab it. Like, there's enough of it. Then that mindset may work. Now we're in the 2024 mindset. Those deals are no longer around.
But let's talk about that, right? So COVID was a virus. That was the reason why you suddenly were alone on the highway. What's the driver for this change, for this shift in SaaS from your perspective?
Okay, a more mathematical approach to revenue. And what we currently see that most of the times it's all about like still acquire growth, right? And that is not the case. It's acquiring the right deals. It's acquiring at the right cost. It's acquiring customers that have an expansion opportunity, not just customers that contribute. Because in many cases it takes more than 18 to 24 months to recoup a profit on that. So if you bring on a whole bunch of really bad customers that don't grow, you bring on a whole bunch of costs and there's a saying, the more customers you win, the more money you lose, right? Like that is a bad thing. That means something is going wrong. And if we don't educate people on that, then we are going to continue to have bad SaaS business. Now they will flush out, right? They will flush out automatically. So from that perspective, there's not that much. What I like to say, and if I bring that back, is we're in that moment of change. So that change is occurring. Like whether I want it, whether you want it, that is changing. Do you know that it is only a year ago that SVB went out of business?
What was that again? I don't actually, SVB, I don't know what that is.
How long was that a topic? Was that a topic for a week?
I think 2
2
news
weeks?
cycles.
Yeah.
2 news cycles. Then it was
Two
gone.
news cycles, right? But like you have to understand, like that was a signal that the market. If I would have told you like 14, 15 months ago that all this would happen, and how that what happened to Hopin and to Convoy and many more to come, right? Companies that are completely financially out of whack, either go bankrupt, close doors overnight. Billions of dollars based of valuations are being like thrown away. Good companies will succeed. Great product will always work. So now, great product, it will be 1 out of 10, 1 out of 20, pick your. But there's a whole bunch of millions, or hundreds, billions of dollars invested in other companies who have a decent product, who primarily have a go-to-market issue.
I mean, and then at the same time, right? So this is one change you're describing there, and then we have this whole AI thing landing in the go-to-market piece. That, I mean, how does that fit in, right? Kind of that's another thing that's suddenly fundamentally screwing with all the fundamentals that we were like, oh, if you're a rep, you need to have an OT of 4 to 5x, and that's how that works. Kind of all of these fundamentals that we haven't seen it yet, but they might be challenged actually by it, right? So kind of how does that play into the current situation?
Yeah, first of all, the reason why we are having this disruption is because the cost is too high, right? And so we're dealing with the cost of people. I want you to understand, and I'll take you to AI and on the road there. I want you to understand there's multiple GTM motions. You have a no-touch GTM motion, like a very PLG style. You have a low-touch GTM motion. Think of an inside sales rep or something. And you have a high-touch motion. Think of like an expensive, not an expensive, but a fielded salesperson who visits customers and who carries an expense report and stuff like that, right? Every time you move up a GTM motion, your cost to acquire a customer and cost to service a customer is somewhere between 5 to 10x. So from no touch to low touch, 5 to 10x. From low touch to medium touch, 5 to 10x in cost. The reason why those costs go up is primarily because of human involvement. Now, human involvement can do great things, but human involvement also can slow things down. And in many cases, we see more and more that customers up to $20,000 are being slowed down by salespeople, not increased the velocity. Buyers would say, well, give me a quote quicker, faster, give me a discovery call this afternoon. Why do I have to wait 3 days from now? And so on and so forth. This cost, today, we see AI as a tool to bring those costs down. We go like, oh, you know what? We can do things faster. We can do this. We can write more emails and stuff like that. And although that is an absolute thought of, and we should consider using AI in that, it's a form of an application. And as we apply AI in that level, it will help us, but only marginally so. What I'm going to describe to you is 2 key things down here. Number 1, those who focus on using AI as an application do not focus on AI building a machine around it. They just focus on like, oh, you know what? My email. Okay, I'm doing AI. That's not where AI is the strongest. AI is the strongest where we close loops, where we bring lots of data together. We draw insights from that. If you focus on application level, you probably are going to miss the boat in some form or shape, right? Because you think you're doing it, but you're not really doing it.
Yeah.
Second thing. AI, the problem with AI is you refer to it as the reason why it so disrupts. It doesn't disrupt just like when Manny came out with Outreach, one of your recent guests, right? He was the only product in the market combined with SalesLoft, but they were in a small category that impacted a small part of the business, aka lead development, right? And so when John Miller came out with ABM, right, it only impacted a part of marketing and part of sales. Tools, when they historically have come out, only impacted a small part of the entire customer journey. AI impacts the entire customer journey, every part of it. So it touches every product. It touches Gong, it touches Outreach, it touches Gainsight, it touches product, everything. And it does that all at the entire same time. And then it does so all in an, in an egalitarian way. Everybody gets reset. Done. We're all starting all over again. And so now this entire market is starting at the starting line, all at the same time. That is why this is such a drastic change, right? And then some of it say, oh, I'm going to use it as an application. I'm going to help me write, like now I have an ability to write automatic emails, while the real gold lies in writing it on a platform level.
And so, I mean, we have the AI piece. We have some of the financing pieces kind of that you kind of mentioned earlier there. What about, and I heard you talk about this another time, but what about some of the pieces that basically have changed since COVID in how employees behave, what employees do, back to the office, not in the office, want to go on a field trip, doesn't want to go on a field trip, kind of how do you think kind of that readjustment, at the back of COVID is impacting this whole piece?
Okay, so when we say GTM, we have a couple of fundamental elements in GTM. Tooling is a fundamental element. Processes is a fundamental element. And human execution of these processes using tools is a fundamental element. If I'm changing the tools, they are becoming AI enabled. And if I'm changing now people, which I'm going to talk about in a second, then you start to understand the GTM as a whole, go-to-market motions, marketing, sales, customer success, account management, every part of it is under a full-blown revival. I don't want to call it attack because that sounds like a negative, but we're under a full-blown modernization, right? This in itself, right, the advent of AI, changing the tools, the change of the financial markets, more cost-centric, more towards sustainable growth that we spoke about earlier, by themselves, those two alone would already cause massive disruption. But lo and behold, we have a cultural change that you're referring to. That cultural change is the third one that we are at the very same time have a reset on. COVID reset all markets that we care about, right? I'm not going beyond SaaS kind of thinking. I'm just going beyond software. It pushed everybody into we were already remote capable, right? We already had Zoom, say, but now it pushed everybody out of the office. And if you go to San Francisco, I mean, we're here in March 2024. I can tell you, San Francisco is not what it once was. You cannot, and I'm not saying living there. That's not what I'm referring to. I'm referring to the buzz in the town, like floors filled with SDRs and AEs, right? Like that no longer is there. That's gone. Mm-hmm. And where are those people? They're remote. Now, at the same time that we pushed them all remote because of COVID, a cultural change occurred. That cultural change cannot be ignored. We cannot say, oh, you know what, it's the millennials. It's not necessarily an age group, although a particular age group is disproportionately impacted. Mm-hmm. It is the mindset of I can work remote and be productive. And this productive versus activity mindset is hindering companies. And we have some metrics I can share with you that shows that this productivity is under severe threat. That cultural change of productivity threat because people are working remote, therefore not as productive as they once were, is causing a lot of disruption out there in the market, combined with with the other disruptions, right? Mm-hmm. Costs are going up, there's less deals going around, valuations are down, AI is coming in to replace it, right? All those things combined create like this heap of a storm that we find ourselves in the middle of right now.
And so we kind of talked about, the financing part. We talked about tools being disrupted and basically kind of your go-to-market motions being disrupted by AI. We talked about employee behavior changing. The last thing is almost like, what about buyers? Are buyers also changing the way of buying stuff? What's happening there?
Let me tell you, if you think about it, you got to see the trend line. When you see the trend line and when you feel the trend line, you go like, look. Do you remember when you bought your first book online or something like that? When you entered for the first time your credit card and bought something, right? How much were you willing to spend that first time on a credit card online?
Yeah, $20 or something like that.
Yeah,
$20, right? Where are you today?
So I can tell you, I bought my car using my phone. I'm just saying.
Okay, so that's your ability to buy a car, let's call that a 50,000 whatever hamburger kind of thing, right? $15,000, 50,000 euros, 50,000 pounds, whatever it is. But you're willing to put it on a credit card because you most likely the brand that you bought it from. You trust the brand. You trust the brand that you buy it from. They go like, look, you probably trust the brand more. Buying from the factory, you probably trust that more than you trusted buying from the dealer. Mm-hmm. Okay. That's $50,000 for an individual. Where do you think B2B companies are headed?
Yes. So I think that makes absolute sense, right? But then there's always kind of in this PLG conversation, there's always like, well, but those processes are complex and it's a complex tool and it's not like just buying a Tesla. It's, it's different. I mean, there's a little bit of truth to that also, right?
Of course, like when you buy a system as a sort of a platform that requires deep integration with database connectors and whatnot, absolutely the case. And there is support needed for that. Now, do you still want to talk to the salesperson to explain to you how that works, or do you want to talk to the engineer who explains you how that works?
Yeah. No,
right? And so
you're totally right. Yes.
Right. And so what we see, and I remember this actually, it was a few years ago, was a story coming out of the German market. I don't know whether it was true or whether it was a thinking that just aligned, but that BMW had replaced its salespeople on the floor with car enthusiasts because they found that a car enthusiast had a higher attachment rate, sales rate than a salesperson had. And whether that is true or not, the idea behind it is valid. The idea behind it is a person who's an expert in a particular topic and can explain that to you in a passionate way is considered, like modern sales. Mm-hmm. Now, I don't think that is a salesperson who enthusiastically twists your arm and negotiates you and has some secret negotiation tactic, right? I think that what it is a person who understands their product very well and a person who understands how you can apply it very well in your environment. I think that those are the professional sales experiences that we're looking for. And today they are very far and few in between.
So I think you mentioned earlier you have some numbers, some stats to share around kind of all of these pieces coming together. Do you have like a couple of high impact pieces that people get, where people get scared about?
Yes. Top, when we think about the bottom X% performance, what historically have we dealt with? What do we call an organization? You fire the bottom X%. How much are we talking about?
Bottom 20.
20. Today's 28%. Okay. When we say the top X%, how much is the top X%?
10, I would say. Actually, not sure.
Today it's 4.4 because now I have to go behind the digit because we're so low. Yeah. 4.4. So what we see is top performance has reduced from what you refer to as the 10% to 4.4%, and the bottom has increased. Mm-hmm. Although those are valuable numbers, that's not where necessarily the big thing is happening. The big thing is happening. What happens in that next two groups? We see that right now that about 28%, that includes with the 4.4, that includes 32%, is performing at a normal level, as in over 80% in the sales performance or over 80% in customer success performance. Mm-hmm. So it's about give or take, give it that 1/3. Mm-hmm. Then let's say that the bottom 20%, which is now 28%, let's also name that 1/3. So we kind of like have three groups, right? The top group that is performing normal, the bottom group, which is not performing, and then there's the middle group. That middle group, that 1/3, that essentially is trending towards the bottom group, not trending towards the upper group. That is a significant setback that we were either worst case that they were stabilizing, but they are trending downward. Now, the top 1/3, given the same amount of opportunity measured across 60,000 records, outproduces that middle group with the same amount of opportunities and generates 1.5 times as much revenue in the sales function than it does the middle group, 1.5 times. What differs? What is different between the top 1/3 and the middle 1/3? The top 1/3 actually takes an interest in what the customer wants to do with it. The middle 1/3 is selling what we got on the truck. That is a problem.
So this is a problem. This is a skill problem, right? We can also go into like, hey, is there something on the opportunity distribution, lead distribution, all of that stuff, right? But ultimately what this means, right? So yes, you have issues on the seller level, but all of those issues, they push through to your top line, they push through to your bottom line, they push through to all the efficiency metrics that an investor cares about, that your CFO cares about, etc. Right? I mean, that's basically kind of just one example for, the whole bow tie being under enormous pressure and starting to simply kind of keel in the wrong direction.
Hence the call that we have here today. Yes. We're in that moment, right? It's hitting us. It's hitting on us productivity level, which has its roots in cultural. It's hitting us on productivity level, which is being disrupted by AI. It's hitting us on the cost structure, which is hitting us on sustainability level. So we're in the middle of that moment, and few people seem to realize and act upon it, right? And look, we just come out of a couple of weeks. We see snowflakes. What happened to Snowflake? We see, and they will come back. I don't think that that's the point, but we see a number of changes occur in the market right now, right in front of us, to what we deemed previously to be successful companies. And now, as they say, when the water starts to recede, like we see who's naked, suddenly the picture that starts to evolve is like, okay, and it all comes down to metrics. It all comes down to pure financial metrics. Are you creating profitable? How much are you spending on marketing and sales? If you're spending, and you can look it up, if you see that the huge amount of companies that spend 60 cents on the dollar of revenue on marketing and sales, that's a lot. You got to do a lot. That's a long payback period. Okay. If you spend, and that's on your public statements, right? If you simply divide for the users who want to take a look, for the listeners who want to take a look, just look at an average SaaS company. Go out, pick a popular SaaS company that you go like, look at their quarterly statement. Just Google quarterly statements, right? Like say, oh, quarterly statement company X last quarter, and then look at the cost of marketing and sales, right? It's a line item, and look at the revenue that they bring in. Divide those two. If you come to the conclusion that they're spending 60 cents on the dollars of the total revenue on marketing and sales, that is not of the newly acquired revenue. That is of the total revenue. Last time we were on here, I was telling you that the cost of acquisition, if I divide those numbers against new revenue, we were in the 150 to 160, 170 range. Today, we're in the 260% range.
So, I mean, we talked about the background. We talked about the stakes here. The other thing is also who shouldn't get shit scared right now, right? I mean, it's like it's one thing, you can scroll through LinkedIn. You've seen these trends a little. I think many things that you just said weren't completely, wow, I've never heard of this, actually. The problem is putting them all together, realizing that they're all impacting one another in like ways that we don't actually have a good way of comprehending this thing. I mean, it's almost like, who shouldn't get shit scared based on what they're listening to right now?
Okay. If you have great product sells. If you're less than $10 million, below $10 million, folks, it's all like you should do whatever you get to the first $10 million. So anything below $10 million, I wouldn't call it fair game, but you should just go out, get on an airplane. Don't look at costs and don't look at tools. Don't use AI as you see fit. Whatever gets you there to $10 million, it's fantastic. If you have a fantastic product that people are buying off the shelf right now, vertical SaaS, for example, has a lot of that. You have less to worry about. Those market. Vertical SaaS is a fantastic. What is vertical SaaS? Salesforce sells CRM to everybody in the world. IDEX sells a CRM solution to veterinarians, right? And Intap sells a CRM solution to lawyers and accountants, right? So there's a lot of companies out there. That's vertical SaaS. You're focused on a vertical market. Why does that work? Veterinarians are not impacted by much of what's going on in the world. Like lawyers probably only get improved, right? So vertical SaaS, relatively isolated, unless they get over 400 million, because then they too no longer are vertical. Like a vertical market is like up 100 vertical, 200 vertical. At $400 million revenue, you become a global market, no longer a vertical SaaS market, right?
Yeah.
And so those are all isolated there, but are to some point. Others, you're going to see that companies in which the CFO plays a key role in the decision process and understands how the rocket works, those companies will do well.
So let's roll in the crystal ball and let's look a little bit with all of these things that you're seeing. What's going to happen next year?
Okay. First, we're going to see NRR continue to create an impact. So that, dependent on which vertical, will take 3-6 months. So it take us to through the summer. After that, as more and more companies have now struggled, have solved it, as fewer companies have, the realities will set in that that SaaS companies adhere to a new business model, and that people need to understand that business model, and that the margins are now so thin that we need to calculate out 3, 4, 5 years into the future how much profit we're going to make out of that. That NRR of next quarter, an NRR rate that is being reported for Q4 of 2024, doesn't indicate what NRR will be in 2025, 6, 7. That we need to actually know what that is, and that we have to calculate and build our business around that. That will be the trend. And in that, systems and processes. I want you to think of the following. The pendulum swinged all the way to like a free flow style. All the way. Green grass. Where is that pendulum going to swing? It's going to swing the other way. What is the other way? If I call SaaS in 2015, the free minds, grabbing, like everything up, what is the opposite of that? Where is the pendulum going to swing, Tony?
No one buys anything and everyone churns everything.
Yes, I think that, with 35,000 SaaS companies, it is correct to assume that we will see a change of how many companies, and we're just coming out of Drift was just acquired, and Catalyst was just acquired, right? So we're going to see a lot more of that. So we're going to see that merger and acquisition, and fewer are going to come out of that. But the other thing that is like the opposite of caring free and doing free is systems and processes. And if you see how many car manufacturers there were in the 1920s, and if you see how many there are now, and you see what has happened, it is essentially the Industrial Revolution that changed. If you go through 4 revolutions, that changed it from 1, 2, 3, 4, and we're today in the 4th revolution. Note that marketing and sales, the GTM function, is about 30 years behind manufacturing. We often think we're this advanced. We barely over the past decade have touched automation in go-to-market, right? This was something that was already happening in the 60s and 70s in conventional manufacturing. Now we are now AI. I believe that AI will help GTM gain foothold. I'll explain that in a second. But that pendulum is swinging the other way to systems and processes, which benefit from AI, which lower the cost, which we just addressed is a problem, which increases sustainability, which helps the investor interest. All these things are benefiting by that pendulum switching to a systems and processes approach.
And I mean I've been talking about this a little bit. I mean you see some of the consolidation there happening, but some of that is not only also go-to-market driven. Some of that is also cap table driven, right? So I don't want to take us kind of off in the wrong path, but to a degree, some of these cap tables with their valuations, there's just no way out, right? They cannot grow into those valuations. They cannot actually deploy the cash or get more cash in order to get there. So there's, I started calling it kind of a walking dead situation also, right? So it's not actually only kind of some of the inability to sell and grow, but it's actually the inability to add more venture capital or whatever they need in order to get to some kind of a cash out date.
Yeah, absolutely right. Imagine that not imagine. Over the past, before ChatGPT came out and before AI became a more widely available resources at a fraction of the cost, right? That's the other thing. AI became available, but the cost point that it became available and the application, that was unheard of, right? Imagine that you would have, like I think we spoke about last time, you're, like a company that deployed for 3-4 years, a whole group of engineers in some think tank somewhere to do that. And suddenly overnight, like that one is not only is it now free, you're behind because that was available for free is better than what you have. That's what happened. That will and should have an impact on the valuation because previously your valuation was based on you having this advanced development in AI.
Yeah.
And you no longer have that.
So kind of in connection to this, how do you think people are going to steer those companies differently, right? Because all of that stuff is happening around them. Sometimes they're seeing it, sometimes they're not seeing it. But CEOs and people running those things, they need to change stuff around. What do you think? What do you think is going to happen there?
Let me give you the solution to, because I got we are all like struggling, like, okay, but what? Tell us, Jacco, what is the solution to this? Okay, the solution to this, and I use an analogy. The solution to this is to think about your business beyond $10, $20 million, with that note, beyond $10, $20 million, your business should be treated as a revenue factory. Now, what is the goal of a factory? What's the number one goal? If I build a factory, what is my number one goal of doing with a factory? Like I'm building a factory for bicycles, skate, whatever it is, you pick it, right? What is your goal of a factory? Number one thing.
You want to churn out bicycles.
More bicycles.
Yeah.
Production.
And not have them break like mine did the other day.
Yeah, and you wanna have it like, run like clockwork. You don't want to have a bike here and then bike there. You want to have bikes all the time.
Okay, so you want to produce lots of bikes that don't break, quality, right? And what is this what are we doing with this venture? What is extra? What are we
to make money, Jacco?
We need to make money. The 3 goals of a factory: production, profit, quality. Now, quality was a latecomer to this game because they forgot about quality. And what happens if you eliminate quality and you want to increase production and you want to lower the cost? Your quality is going to suck, right? So they figured out later on, it's like, which gave rise in the 1950s, 60s to the quality management like thing, right?
Yeah.
So number one thing, think of your machinery as a revenue factory. Your SaaS company is a revenue factory beyond $20 million. Now, a factory has production lines. Can you think of me what inside this revenue factory we call SaaS would be a form of a production line?
Emotion, outbound, inbound, partners, and then all the wonderful exotic stuff.
Like
what is
podcasts.
it? Event-led. What do you have? Community-led. All of these wonderful new things that we have.
A GTM motion.
Yes.
So if I have a PLG-based inbound motion, that is a motion. If I have an enterprise motion, that's a motion, right? And these motions are essentially factory production lines, right? And so if I have, and you see this commonly, and like I said, we obviously at Winning by Design, we see a lot of this. Companies at like $100, $200, $300 million are operating and generally are dependent on 2 to 3 factory lines that produce a lion's share of the revenue, right? And often you'll see this. What you see when a GTM motion aligns really well with the product, companies explode. Inbound and which company?
HubSpot.
HubSpot, PLG, and
Atlassian or Slack.
Slack, Atlassian. When the GMT, the go-to-market motion of a company lines up with the product, it skyrockets, right? Like that's where the... Now, what you'll see here is that these production lines have a capability of producing. We call that scalability. How much do they produce? And they have a cost structure with it, which we nowadays refer to as sustainability. Is that production line sustainable and scalable? Here's what you see. Lots of people spend too much money on GTM motions, factory production lines, that are not producing enough revenue. That are just like that's a common mistake. We are spending like disproportionate amount of cost on a GTM motion that is not producing. Now, what that also means is we're not spending it on the GTM motion that is actually generating growth. Why is that? Oh, we just turned over the new VP of sales or the new VP of or the new CMO who decided that we were going to change X, Y, Z. They decided we're going to change the tools, we're going to change the methodology. And so you suddenly railroaded an existing and functioning go-to-market motion, production line. Suddenly somebody stepped in and changed that. So number one thing, think of a factory. Realize that the goals of a factory, growth, cost, efficiency, and quality line up perfectly with our SaaS services, in which quality is what we refer to as impact, right? Divide that in go-to-market motions and run the analysis, financial analysis on these go-to-market motions. Are they scalable? Are they sustainable? Now, here's the thing that I want you to think about. In year 1, is a go-to-market motion sustainable?
Nope.
And why not?
You follow the S-curve. You need to figure this out. It's going to be shitty in the beginning. At some point, you're going to hit the acceleration, and then it might be great.
Okay, but if I launch a GTM motion in year 1, let's say that enterprise motion brings me $2 million in sales. Why is that not sustainable in year 1? What is the major cost that I incur in year 1?
I mean, the boot up cost, right? And you also don't know if, what you have been doing, is that repeatable even, right? Kind of there's a couple of questions still that early on in a motion need to be answered.
And at the same, your answer comes, the client acquisition cost is really. So now you amortize the client acquisition cost over the revenue that comes in the future years, right?
Yeah.
Now remember when you said earlier, hey, Jacco, when we sell perpetual software, I get profit 30 days later. But right now, I need to amortize the client acquisition cost over the next years. How many years, Tony or Mikkel? How many years?
So enterprise, I mean, I don't know. It might, I mean, it needs to be, I mean, this is accounting, right? It needs to be over the lifetime of the customer actually that you acquired them with. If that's the bookkeeping question here, Jacco.
How do we calculate lifetime? Follow my thinking here. How do we calculate lifetime?
Quality, right? Kind of that's you know, how long you do have the impact. Is it multiple years? Is it
Love
1
it.
year and so forth, right?
And what is lifetime? How long is it at average?
For enterprise, what, 3 years maybe?
No. Enterprise is kind of high, it's like it's a 5+, but I mean, who knows in the beginning of a motion, right? It's very difficult to know that in the beginning.
Okay, you say who knows? That's what I'm going to pull on. If I buy a product, if I buy a router from Cisco or something like that, right? I don't say, when I buy it, I don't say, well, who knows how long it's going to go? No, the finance department has a word to say about that.
Yeah.
The finance department amortizes that and says like, okay, we're going to do that over 3 to 5 years. Here's my take. We need to think about SaaS platforms as we amortize. We cannot live with a variable lifetime horizon value of some sort. We can't say, well, some product is 5 years, the other is 7 years. We simply need to say a product, if we sell a SaaS product on an annual license as a platform, CRM, an ERP, market automation system, if we do that, then we need to look at it over 5 years, how much profit that brings us. And that profit needs to be at a certain rate, 20%, 30%. On an application, it's shorter. Like think of a Calendly, is not as sticky as if I installed a HubSpot. HubSpot should do easily 5 years. Calendly should do 3 years, but then, you know, like it may be integrated in some product and stuff like that.
This whole analogy is really centered around the go-to-market piece, right? Because if you go really profit, then a couple of other things also need to be considered here, right? But, you know, to kind of bring it a little bit down to earth, right? Isn't what we're kind of talking here about CAC to CLTV, so customer acquisition cost ratio over customer lifetime value? Isn't that part of the equation that you're thinking of?
Okay, I want you to think of following layers. At the bottom layer, I'm looking at volume metrics, how much MQLs did I get in, right? How much revenue do I generate? And conversion metrics. What's my win rate? What's my churn? And so on and so forth. At the top level of that, I create, you know, like performance metrics out of that. Performance metrics is where I say, well, I paid that salesperson X and they generated a deal. So now I can hold the two of them and say, okay, on average, we generate X revenue. That's, in this case, I use that as layer 2. Layer 1, pure metrics. Layer 2, we're calling performance metrics. Layer 3, finance metrics. How much was the lifetime value of the customer? How much was the client acquisition cost? And layer 4, investor metrics. What's the CAC to LTV ratio? How long do you think before the metric at layer 1 achieves a metric at layer 4? What is the time frame between?
Okay, so it's basically kind of between the operational stuff that someone is doing and something is happening, and the delay and lag kind of all the way through, right? Kind of that's your question?
Yeah.
I don't know. Like, I mean, so for example, net retention rate, if you take that one, that's going to take at least a year until the next renewal point, right? So if you're selling enterprise, you know, software, you're kind of going to wait a year before you have that updated metric, basically, that impacts then, you know, the CAC to CLTV, for example.
Okay. Driving, you know how it's harder to drive a car backwards than forward, right? Because the wheels are at the back, right? If I attach a truck to it, it's harder to drive a truck backwards with a load because my steering is opposite, right? Because there's a delay in response, so to speak. Okay, I want you to think, if we're going to continue to fly the business on an operational level using investor metrics like CAC to LTV ratio is like driving a truck backwards on a highway and trying to reach 80 to 90 miles an hour. You won't get to speed because that thing, you're driving it the wrong way around.
Yep.
We need to drive it on an operational level, meaning we need to drive it on the metrics that take place on the lower level. That lower level metrics is the reason. Now, that doesn't mean that the investors are causing a problem down here. No, they're not. They're doing what they're doing and what they're supposed to be doing. We should just stop driving the business like that. We should drive the business operational metrics. How is the manufacturing line performing? Like the CAC to LTV ratio, whether that is the right ratio beyond, like LTV is undefined, CAC is applied to the entire company over all marketing and sales. I can't run the business like that. I need to know whether my enterprise motion in Europe is working. I need to know whether my PLG motion is growing fast enough that it will become a viable option in 18 months, right? Like those metrics are operational metrics. They are falling under LTV to CAC. And nowadays, what I hear, the popularity about whatever, the rule of 40, like, come on, people. The only thing that those two factors have that contribute to a rule of 40 is the percentage point.
But so
that was a joke, by the
yeah,
way. I didn't see that.
we skipped over that one. No, but so I think you also label them in the right way, though. They are investor metrics, right? And what do investors really like? They like to have, a set of numbers that, fit on, a hand that they can compare companies between them, basically, right? It's like, oh, there's a good company, there's a bad company. But if you take those metrics and try and steer the business through that just doesn't work. That simply doesn't work, right? You have to do it from the bottom up. You have to do it where stuff actually happens. And then what you have to do, and this is what, and this is where I almost would challenge you on the CFO thing, instead of seeing this as we know we need to hit this metric because, hey, this is benchmark. Let's top down calculate how everything needs to look like below. That's also the wrong way to go about it, right? It might give you a directional idea what needs to happen in the bottom here, but ultimately it's what are we going to do here in the operational mud in order to drive the metric that we want to achieve and then have an outcome in order to go in the right direction, right? Kind of that needs to be the way you think about this.
Okay, I like everything you said except the analogy. I want you to think it is the investor mud and the operational clarity, right? Like because the operations is pretty clear, right? And that's the reason why I believe so much in companies like a Gong, because they're even further to the real. They can go into a call metric, right? They can see it's like even further out there. Anyway, point being here is that this level of insight, like look at where we're going from. We're going from the growth at all costs pendulum on one side, and we are now swinging to the other side, systems and processes. Now, here's the good news and fantastic news about that. The bad news is eventually we'll overswing to the systems and processes side, right? 5 years, 10 years from now. But for the next 2 years, we'll be in the sweet spot. That pendulum, as it comes swinging back, for the next couple of years, we'll be in the right mix of a mindset of growth at all costs with an implementation in systems and processes, powered by AI, in a market that is more suitable for SaaS companies, most likely that are not going to try to tackle the entire world as a whole, but more vertically focused. That metric is on that momentum we're in over the next 12 to 24 months.
Yeah. And this is a Growblocks plug here now. If you want to do all of that stuff in a spreadsheet to go from your bow tie model to the other metrics to the investor metrics, you can also come to us and request a demo and kind of see how we're solving that for you.
Look, and we did not set that up this way, right? I wanted to make sure.
We did. No, exactly.
Oh, but the reason why look, there's a group of people that are grouping up and they're starting to understand that this is how it goes. And look, there's no look. I've worked with so many companies over the past over 1,000 companies. You know how many companies, like when I calculate them and say like, hey, what you do technically shouldn't work, and they just hire another 100 salespeople and they go see, it works, right? I go like, it doesn't work. You just got more revenue. Your valuation went up significantly. You went public. And then I see these sales leaders, CEOs on stage. I grew this company, and I go like, but dude, like, you grew I know the stories nowadays. We're talking about companies that are raising having raised 80 to 50 to $100 million, bringing in like $4, $5, $6 million in revenue. Like, folks, bringing in $4 to $5, $6 million in revenue against 50 to $100 million raise. Yeah, like I don't know what that is, but it's not a scalable or sustainable business. I know that for sure, right?
So I think, we had like a section here where we talked about, those sales guys, then, some of them are better, some of them are worse. And, that has changed and there's a skill gap, right? Kind of that's one thing. But then the other thing, right, when you go one level up, which is kind of a skill gap on the leadership level, on the how to operate the business kind of level, right? I mean, I also gotta say, let's just cut everyone here some slack. I mean, there's a bunch of stuff happening at the same time. And I don't think that, the three of us know exactly, what needs to be done and how everything needs to change. I think what we have an idea of is like, hey, there are a couple of methodologies, couple of tools, couple of ways of thinking, how you might be cracking that nut. But I don't think, I mean, maybe Jacco, you have like a better answer for this. I don't think we have cracked the nut either yet, right?
I don't think any of us have.
Yeah.
What I can tell you is, if we look at history and how other markets dealt with that, we're not the first to run in an issue like this. Right?
Yeah.
We're not the first. And like I said, there's a reason why there was a first industrial revolution, a second, a third, and a fourth, right? By the way, there's no fifth. Google it. There's no. So I assume we're coming to the end of existence because, the industrial revolution has no fifth. Also, I just saw the movie Dune. This is a complete sidebar, but
No spoilers.
If you go back, I won't spoil it. If you go back and you listen to where Dune comes from, and when Frank Herbert wrote that story, it was at some point in time AI ruined the world, and therefore they forbid technology.
Yes.
And so anyway,
went
hence
back to
there's
religion.
only a fourth industry.
Yeah.
Sorry.
So Dune went back to religion, basically. Kind of this tech stuff was forbidden, and then, religion instead.
Yes, in a way. But the point is that we can look at other industries and see how they dealt with it. And we're following that same trajectory, we're just delayed.
So, and I think this is a really great hook in here, because the way I've been thinking about this, right? I think there are really prominent voices out there that talk about the golden age of SaaS is over, and we're all doomed, and let's all be grumpy. But I think actually what happened is the convenient age of SaaS is over, right? The boom time of SaaS maybe is over. And really what's happening is the same that has happened to, you called, car manufacturers, then, aircraft manufacturing, you don't want to be Boeing either, right? It's the same thing that's happening again and again. It's a maturity curve. It's a maturity curve of an industry. SaaS is one. And now we kind of need to understand not only how to better manage that thing that we're calling SaaS, but what will come with it will be more tooling, more understanding, more guideline, more intelligence in order to make better decisions, because you're operating on a different margin now. The margin of error is decreasing, just as it has been decreasing for car manufacturers, just as it's been increasing for pharmaceuticals, just as it's been increasing for all the other industries that came before.
It's just, and like that, all those other industries eventually became a factory.
Yes.
It's time for SaaS to become a factory.
Yes.
And again, with the earmark here, that up to $10 to $20 million, it's not. It needs to be like entrepreneurial spirit. It needs to be like going into the jungle with like cutting through red tape with a machete, right? Like all that is up to 10 to 20 million. And by the way, every new GTM motion starts over at zero. So every new GTM motion, until it reaches 10 to 20 million dollars, is starting with that entrepreneurial spirit, which is a fantastic application of your entrepreneurial founder, right? Like, hey, we may run a business at $120 million. That may not be much to the skill set of the founder any longer, but we're launching a new business unit that starts at zero. Redeploy your founder in that, because they are the ones who can cut through the red tape with a machete and get it going again, right? And they start 0, 10, and so on, and that adds up. Like if you bring back, every growth follows the S curve. The S curve is a summation of all the independent GTM motions that you're having, your factory lines. Each GTM motion follows a form of that S curve. That S curve, when we look at that GTM motion, each function in that production line has a conversion rate somewhere. That conversion rate can be translated to a trend line. That trend line is either going up, more sales is being, that could be a win rate, could be a trend line. Discount could be a trend line. Churn could be a trend line. The conversion rate from lead to opportunity. All those need to be optimized. When you look at the business like that, you're running a $200 to $300 million revenue factory. If you do that at $10 million, you run it into the ground.
Yeah.
Right? Now, that switch, if you see today, where is the mindset? The mindset never switches from that one to the other. When you go to school and you come out of like college and you go to the next school, right, university or whatever it is, you clearly have an earmark, like, okay, you clearly have a marker. This stage ended, this stage started. We don't have that in SaaS. We don't have that clear marker other than IPO, which in many cases is too late, right? But like we don't have that clear marker. So we never feel like, oh, we're out of the $20 million startup phase and we're into the $200 million scale-up phase. Companies historically, today it's changing, they kept operating in the startup phase. They kept operating in the growth at all costs to 200, 300, 400 billion, 2 billion. And there's numbers that goes above that, right? 5 billion. They keep operating in that. Those days are over, and you call that the days of convenience. I think that is appropriate. I don't think it's the days of what you the days of rapid growth are still here, and they are still coming. It's just for a new generation of company. We have a CFO more in control and a CRO that has a CFO mindset, rather than a CRO who has a CMO mindset. And I don't want to cut the CMO short down here, by the way, because if there's one role that is going across the entire customer journey these days, it's the CMO. They do see the complete impact of the customer more and more.
You know what, Jacco? I think...
What? Help me!
I think this was okay, interesting. You know,
was it because we buttered him up so much in the beginning? Now you just want to bring it back down.
So we are missing the music from Jacco. You know, that's not here. He hasn't taken off his sweater yet.
No.
I mean, look at that, right?
I can do one for the team and just.
It's fine. Jacco, this was fantastic. I hope not everyone is, looking out the window and thinking about whether or not they should jump now. But I think there's a way out, right? I think it's really important to understand this is the stuff that's happening. But there's a very clear way out and kind of managing throughout that change.
Look, I pick up something from you, which to me is not necessarily the wrong conclusion, but it's you interpret this as a like, hey, it's the doom day. I interpret this as this is a fantastic day. Because here's my problem. Over the past years, my ability to forecast who is successful and who is not successful had more to do with which VC was behind it and if their pockets were deep enough to keep funding the losses. The future that I'm seeing is the right products that are bought by customers who want it, who end up being profitable, are going to succeed. So to me, this is like the phoenix rising from the ashes kind of moment. This is the moment where we're in. I go like, finally, because this makes sense to me where we're going. Yeah. Where previously I was going, like, I sit there with founders. I go like, I have no idea, but they just pulled up in a Lamborghini and they got like, but I have no idea how they got this far. And it was primarily on some VC backing that was unlimited funds. To see that those days are coming to an end and that the days of reason and production and whatnot are up is exactly where I believe. Like, that excites me more than the previous phase.
That's it.
Wonderful.
You know, Mikkel is kind of giving the sign like, hey, it's Tony, shut up now.
I mean, so this was a really wonderful episode. We're gonna go cut it. We're gonna go wrap it and then ship it, and then turn this into a really wonderful episode for the listeners. So, Jacco, thank you so much for joining us once again. And I mean, we can always offer you a standing slot on this show because you tend to have a lot of great insights for our audience, at least, and we definitely appreciate being able to amplify some of the important insights that you share. So,
Jacco,
thank you.
This was great. Thanks so much, man.
It was a pleasure, and thank you for all the listeners for being with us today.